Welcome to today's session and thanks for joining. In these videos, I show how you can swing trade profitably in any market condition, up, down, or sideways, by taking only high probability and low risk trades that have maximum forces from the market, sector, industry, fundamental, technical, and even seasonality in their favor. I will revisit some trade ideas I shared recently before knowing the results as usual. I will explain how I am managing those and why I closed many of them this week. If you stay with me, I will show some stocks getting ready to buy or short, and you could trade them on Monday itself. You could also trade them on Friday near the close if you could find them in real time. Using Q systems, you could. This week I closed many of my long positions. I think all of them with a profit. I'll look at some of them. So I thought today's session is right one for the theme, when to hold and when to fold it, for swing trading with confidence with live examples. Finding a trade and taking it is only part of trading profitably. You also need to know when to cut loss if need be, book partial profit, book full position, or hold the full position longer. Those decisions are not the same in all market stages. If you think of the stage 1, 2, 3, 4 of market, bottoming, uptrend, consolidation at the top, and declining, the decisions can be different in these different stages for swing trading. Those decisions may be different for different instruments too. Stocks and options may have different decisions. Also, because of we all being different, traders may pursue different approaches. Over time, you will find out what suits you. I have found that out, and here are some ways I make those decisions. In a strongly bullish market, or not and but or in a stock acting very well meaning moving in your direction, you may hold the full position longer. I will show a live example later today. So I took this trade as a swing trade, but it moved so well in my direction, I did not book partial profit. I am holding the full position. About uncertainties related to earnings. If a stock is nearing earnings and the position has a small profit, it may be prudent to book full position profit. So if the profit is small, there is no cushion, book the full position profit. If a stock is nearing earnings and this is a different case, the position has a large profit, it may be okay to book partial profit. Always book partial profit to take some money off the table and then hold partial position. It is okay to do that. The large profit provides a cushion. It is also okay, of course, to book full position profit before earnings, because these are not long-term investments to start with. These are all swing trades. One thing that may help in deciding whether to close full position before earnings or hold partial position when the profit cushion is there is the earnings quality from Q Vital. If the earnings quality is strong, then you may decide to hold partial position with profit cushion. But if earnings quality is poor, then it is advisable to close full position. That way, Q Vital can help you to make that decision. Those were for stocks. The decision is not the same for stock and option positions. For example, for a naked short put of far expiry, say 90 day to expiry, it is useful to hold the trade through earnings. In 90 days period, we are expected to have at least one earnings. It is useful to hold it through earnings as time decay and volatility crash both is in your favor. And of course, the longer expiry was decided knowing it would span across earnings. So if the trade was taken knowing very well that it will span across earnings, why not just hold it? The decision was to be made at the time of entry, and if 90 DTA, may as well hold it through earnings. At the same time, if the position has a good profit and you want to book it, there is no harm in doing that. I will later on discuss some ways that you cannot go wrong. Now, instead of a naked short put, if there is a defined risk vertical trade that has a profit, be it large or small, before earnings, it may be better to close the full position to avoid possible profit erosion or to avoid the trade going into a loss. If the position has a small percentage loss, let's say about 5%, then also it may be closed before earnings. So before earnings for vertical trades, book it whether it has a small loss or a large or small profit. But if the position has a big percentage loss, let's say 75% of percentage loss in the vertical trade, it may be okay to hold it across earnings, not close it, because anyway 75% loss is there. Hold it across earnings because it may turn into profit. I will show a live example of this, of the initial case where I had a profit in the trade, earnings is nearby, and I did close the trade last week. That was about earnings, but options also have expiry, and expiries may be handled in a similar way. If there is a defined risk vertical trade that has a profit 1 week before expiry, large or small profit doesn't matter, it may be better to close full position. Also, if it has a small loss, say 5% loss, then also it may be closed. No point taking the high level of uncertainty that comes with the very short days to expiry. On the other hand, again, like in earnings case, if the position already has a big percentage loss, let's say 75% loss, it may be okay to hold it to expiry as it may turn into profit. Not as it turn into profit, as it, let me correct that. As it may turn into profit. So vertical trade already in a big loss 1 week to expiry may simply hold it through expiry because it may turn into profit. I will show a live example of this later today. Live example of the profit case where I had a profit, expiry is nearby and I closed it last week. Also, and this is related to current market condition, if the market is very overbought, Q-edge bucket analysis shows that it can show that in real time. Q market breadth charts also show that. I'll share both of these later today. If the market is very overbought and you have many long positions, I had more than 20 long positions going into the weekend, going into the Friday's close. it may be prudent to reduce positions irrespective of whether they are in a small profit or small loss. So I closed a large number of positions on Friday when the market went up. The stocks also went in my favor. However, because the market became very overbought, I did not want to take risk with so many long positions. I reduced exposure by closing many long positions. I'll show an example of this, a few stocks later today. Large profit positions may be held, of course, because they have a cushion. The ones I closed, they did not have a large profit cushion. I will share some of those later today. These decisions become second nature and automatic with experience. New traders or even experienced traders but who are not consistently profitable. Experience does not mean they are consistently profitable. They may find these decisions to be less easy, and therefore there are some guidelines with which you cannot go wrong. I'm going to share them now. Here are ways you probably cannot go wrong with, provided you have a reasonable, let's say 60% or more success rate in swing trading with stocks. So this is about stocks, not with options. Case A, book full profit at 1:1 reward risk ratio. Choice B, close 2/3 of position at 1:1 reward risk ratio and maintain stop at the initial level and track it. Case C, close half position at 1:1 reward risk ratio and move stop to break even and track it. So you could apply all of these three. You cannot go wrong with any of them for swing trading stocks. Now these three all are applicable, but they are not the same. The choice of booking full profit at 1:1 reward risk ratio is the easiest one. Mathematically, it works out just fine. You may refer to the philosophy page on Superior Profit Co website for more information. It will show mathematically, irrespective of the trading system you are using, that booking profit at 1:1 ratio works just fine. Also, trying to get higher reward risk ratio for swing trading may not always justify the additional effort versus additional profit. The moment you book partial profit, you have to manage the remaining position actively. That takes effort, and only partial position money is working in the market. The additional profit may not always justify the additional effort. However, and this is an important however, for many people, traders, trying a higher reward risk ratio may provide additional fulfillment, even if there is no material increase in overall profit. And fulfillment in trading is something that may not be neglected. So if you are more comfortable booking partial profit and for fulfillment purpose at least, maybe have some additional profit but may not be commensurate with additional effort, but still fulfillment is important. If you feel comfortable doing that, you may hold partial position. That is for you to decide. And this was for swing trading. The 1:1 reward risk ratio works just fine. That comment I made. For position trading or longer term investing, one may certainly, and by necessity probably, aim to have higher reward risk ratio, not 1:1. That was for stock trading. For options trading also there are cannot go wrong approaches. Let me share some of them that I follow. For swing trading with defined risk verticals, book full profit at 50% of max profit. This is again the easiest one. You may just place a GTC profit booking order, full position profit booked with GTC order at 50% of max profit. Easy to carry out, no second guessing. Just like in case of stock trading, there are other options, but that needs more effort, may not be worth it considering the incremental additional profit you may get. But again, fulfillment is important. The other option is if market, industry, stock, everything keep moving in your trade's favor, meaning you have to keep an eye on all of them. Keep an eye on industry from Q edge, stock from Q vital, and technicals from Q charts. You have to keep an eye all of them, and if all of them are moving in your direction, wait a bit longer, but always book profit at 80% of max profit. Not wait after that. It is not prudent to carry the trade beyond 80% profit level as risk increases disproportionately compared to additional profit potential. For most of my vertical trades, I close them around 50 to 60% profit, sometimes maybe 40% profit. I don't wait usually for 80% unless very exceptional case. It needs more effort and really exceptional, maybe not even 10% of cases I am waiting for 80% profit. Maybe not even 20. Most of them I am closing at between 40 to 60% profit. And beyond 80% I never hold it, it's not worth it. Naked short puts are different. For naked short puts, the underlying assumption is that if required, I will hold the stock as a long-term investment. That is my underlying assumption. So I'm taking swing trading, but in the worst case, I'm ready to hold the stock. It can be for position trading also using short puts. Again, the cannot go wrong approach is place a GTC order to book profit at 50% of max profit. Cannot go wrong with that. If the stock keeps moving in your favor, you may wait longer. You could book profit at 80% of max profit. And here it is okay to wait beyond 80% as well. Because again, the underlying assumption is anyway, one is ready to hold the stock if required. They will just buy the stock at a lower price because of the premium received from shorting the put. And therefore, if you are okay with holding the stock anyway, longer term if required, for example, a high dividend yield stock, undervalued stock probably, maybe a stock where industry is getting stronger, you are able to catch it at the bottom and the short strike is below current price. Meaning if you get assigned, you will buy it at a lower price than current price, plus you have got some premium, then you may not book profit even at 80%, but let it expire for 100% profit. Of course, if 80% profit is reached within, let's say 1 to 2 weeks of entering the trade, it is better to exit the position at 80% profit, even 50% profit, if it is reached quickly. But let's say 80% profit is reached only 5 days before expiry, then you may hold the position for the remaining 1 week, just 5 more days, and try to get the remaining 20%. Again, the underlying assumption very important to keep in mind that if required, willing to hold the stock long term because of its dividend. I will show an example of this later today, live example again. In today's session, I will show how I used concepts like this in live trade ideas. Which trades? The ones that I shared recently in Market Recap YouTube videos or on Twitter X. Greetings, I am Sagar Nandi, retired IT professional swing trading stocks in USA and India markets using Q systems that I developed myself. You may contact me using my email IDs info@superiorprofit.co or tradingprofitably@gmail.com. I regularly share live market and stock analysis on my website superiorprofit.co, X handle Superior Profit, and YouTube channel Trading Profitably. All these are open to the public. You are most welcome to make use of them. Q Systems run on Metastock and TradeStation platforms. It has multiple components. I'll use several of them in today's live session. Disclaimer: this demonstration is for educational purposes only. I am not an investment advisor. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. Options trading can be risky, does not have to be. I trade them all the time. You may refer to the characteristics and risks of standardized options document from OCC to decide if options trading is suitable for you. Now to the live systems. A lot of things to cover. First, let us have a look at one instrument that tends to impact the market quite a lot sometimes. That is the dollar index. It is inside a range created by trendline resistance and support. As I mentioned earlier, as I anticipated that happened, the supports held, it went up. As I anticipated, as I explained earlier, the resistance held. Now it is back to support again. It has already moved considerably from the recent high. That makes it more likely, not guaranteed, but more likely that the support will hold. Doesn't mean it will necessarily go up back to the resistance, but it will hold at least for a few days. After that, we don't know whether it will go back up or maybe break down, but I think it is more likely than not that the support will hold. And if that happens, it will put pressure on the market, including the mega caps. The trend lines work very well. Now, talking about mega caps, the mega caps were instrumental in moving the market, specifically QQQ and SPY and even S&P 1500, even NYSE Composite and Nasdaq Composite higher, because they are all heavily influenced by how the mega caps move. They are all market cap weighted. IWM is also market cap weighted, but it does not have mega caps in it. The others are very much affected by mega caps. Not DIA. DIA is not market cap weighted. So let's look at the mega cap custom index. That is part of Q breadth charts. What we see is that in weekly we have a bearish headwind, never to be ignored. That is to be noted. In the daily, we are right at trendline support. If the trendline support breaks, that will prove bearish for the mega caps as a whole. Whether any mega cap will have a short setup or not, that we may find out from the individual charts, but if the trendline supports break, that will be significant. The supports held for a very long time and mega caps were super strong, going up, up and up and up. So if the trend line breaks, it will be significant. Now, as you may remember, I took a trade in Netflix. That was a bearish trade, and that also used bearish headwind. In the mega cap custom index, we have bearish headwind in weekly, but let's look at Netflix. Now going back to reviewing some stocks. that I shared earlier publicly before knowing the results. Let's look at also in TradeStation using QElite. Yes, sometimes I use QElite, sometimes I use QGlobal. Why I came to QElite on TradeStation is because this is what I used in explaining the trade in the earlier market recap. It had a bearish headwind in daily and in weekly, and at that time there was a trend line support. The trend line support was here. I took the short trade before the support broke, and I mentioned that in the market recap I took the trade before the support broke. I used the bearish headwind in daily and weekly both, and to be on a safer side I used short call vertical. As often happens after bearish headwind, price tries to go up, creates a false upside breakout and comes down, and the trend line support eventually got broken. Because I had a short call vertical, time decay and delta both worked in my favor. It came to the yellow direction line support and held it there. And this is an example coming back to today's theme. This was an options vertical trade where both expiry and earnings in both are coming in 1 week. So my position will also expire right after earnings, 1 day after earnings, and earnings is coming soon. So I did not wait. I had a sizable profit. I closed the full position. So earnings nearby, expiry nearby, vertical trade with a large or small profit or with large loss, in this case medium size profit, book the full position. That is my approach. That is what I followed. Interestingly, if you look at the mega caps, I put the mega caps in Q Finder, that is the performance finder. I applied the weekly interval. Of all the mega caps, only one, Netflix, is down for 1 week, 2 week, 3 week, 4 week. Now people are all taking notice, isn't it? Now they can see for 4 weeks in a row it is down. That is the beauty of the headwind signal. I could anticipate a reversal, I could anticipate a breakdown, take a relatively lower risk trades, defined risk trade with verticals, and made a profit. And I made a video recently on how to anticipate reversals. That was the theme of one of my recent videos. You may rewatch it. I applied those concepts perfectly in taking the Netflix trade, and I applied today's theme perfectly to book profit in the trade. If mega caps have such an impact on the market ETFs, let's look at them. Let's look at QQQ, and you will find something common between the market ETFs, and this is QQQ. Let me first go through the 4 ETFs and see if you can identify the common thing between all of them or similarity between all of them. It is near jump thrust high, price extreme high, came big move down 3 on Thursday. Also displayed the bearish headwind at the very top. Weekly has bearish indecision at the top. And if I look at the historical chart, it broke a trend line support on Thursday. And I was watching it like all of you. QQQ was going up, up, up because of the mega caps mostly. And on Thursday, it reversed. I was waiting for the reversal. So I did not wait for the close. Let's move to the pivot chart, and in the morning session I was using 5-minute interval. Thursday Thursday price opened higher. Go back to daily interval. Thursday price opened almost at the same price as Wednesday's close, almost at the same price. Wednesday had a rally day and then immediately it started to go down. It was already at jump thrust high, it was at price extreme high. I was waiting for a reversal, so right somewhere here I took a quite a large number of short call verticals in QQQ. It had a nice profit by the close of the day. This was a vertical trade, defined risk trade. So I was not in a hurry to book profit. That was Thursday, right? Market was going up, though QQQ and the mega caps came down Thursday. And then on Friday, it tried to go up but closed lower. That's why it has a upper tail and it closed with a bearish indecision. So now weekly, daily both has bearish indecisions. Daily has bearish headwind and bear release. We have a big move down 3 near jump thrust high, price extreme high. Those are enough reasons to hold at least partial position. So initially on Friday, QQQ went up, but it sharply came down, though closed higher than the open. But it is looking quite bearish to me, bearish at the top, meaning a reversal sign, not a downtrending stock by any means, but a reversal sign. So I am holding partial position on the short call verticals, but on several of my lots I booked profit. As I mentioned, I took a large number, quite a large number of positions. I had some profit. I did not want to hold all those large size positions in QQQ single instrument. I am holding partial position, but many of the lots I closed, and also the lots were using different strikes. Some of them had higher profit, some of them had less profit. So I booked profit in the more profitable ones first, and also some had longer duration to expiry. So when I traded it throughout Thursday, I took some 21 days to expiry, around 20-21 days, and some around 40-45 days to expiry. The ones that are near 20-21 days to expiry, I closed all of them. The ones I am holding, short call verticals, they are now of longer term expiry. Remember, after bearish headwind, it is not uncommon for price to go up and then create a false upside breakout. That's exactly what happened in Netflix. That's not uncommon. So I reduced risk, increased my chance of profit by holding the longer term expiry and closing the shorter term expiry, but closed all of them with a profit. When to hold it, when to fold it, when to book partial profit. I booked partial profit in this case. Let's look at SPY. This is at jump thrust high, not near like QQQ. Displayed a bearish headwind and bear release in daily on Thursday at price extreme high. Enough reason to be cautious. It did not have a trend line breakdown, but it has bearish headwind at the top at jump thrust high. Reason to be cautious. Not downtrending by any means. None of the market ETFs are expected to be downtrending. We all know that. We are discovering warning signals. IWM, small cap. Interestingly, you are observing as I am, it is as if first the mega caps went up, then industrials, then small caps trying to hit high one after another, luring people to buy the top, not me. IWM was underperforming for a very long time. And just for last 2 days, it sharply outperformed. Shown by this relative performance line. Thursday, Friday, huge move up, huge move. gap up and then continued to go up on Thursday. On Friday, gapped up, closed higher than open, but has a very long upper tail with bearish indecision signal. Weekly is at the watermark created by bearish headwind. Remember, again the same thing is coming into play. After bearish headwind, it is not uncommon for the instrument to go up and test the watermark created by bearish headwind. Now if it comes down little bit, it will create the false upside breakout that often comes with such a breakout, false up, and that will be a time to short small caps. I am aware of that. I am aware that the false upside breakout has not happened. I am aware of the bearish indecision. I booked profit in more than 10 long positions on Friday while the market was rallying. Some of them were small caps. And Daya made a new all-time high on Friday, but again the same theme is coming into play. It retested the watermark level created by previous weekly as well as daily bearish headwinds, but closed below that, meaning it has already completed the false upside breakout. Has a bearish indecision in daily. If it continues to go down next week, I'll be less inclined to short dia or industrials because it has trendline support nearby. Whereas if I look at IWM, it has trendline support far away. If IWM creates the false upside breakout, I'll be more happy to look to short small cap stocks. And the same is true for QQQ. QQQ, I have a bearish position already. SPY also does not have a trend line support nearby. So if it comes down, it will be a reversal trade. We'll have a reversal trade in all of them if they come down, not a trend following trade in the bearish direction. And I asked what is similarity between all these. The similarity is all are near all-time high, at all-time high with many bearish signals, specifically bearish headwind in all of them, either weekly, daily or both. That is a cautionary signal. That was an external view flashing cautionary signals at the very high. What about the internal health check? Let's look at the total view. An extremely useful single page internal health check. What does it say? Okay, it is loading the data. While it is loading the data for the total view, Metastock is acting weird. Slowly, let me share the composite breadth. Not total view, but the Nasdaq and NYSE breadth. And I will point out to one important oscillator. Again, this was discussed in the video with the theme how to anticipate reversals. Very useful oscillator, 3-month new high low. For the composites, both of them it is hitting extreme overbought condition from which a pullback is likely. Pullback of what? Pullback of some of those stocks which went up. We can easily find them from Q index and Q finder using them together. So both the dimensions Nasdaq and NYSE are flashing cautionary signals, and of course before that we had many recent Hindenburg Omen confirmed signals in NYSE, many Bango irrational exuberance at the top signal in Nasdaq. Enough reasons to be cautious. But not only in composites, if we look at the individual major indexes, Dow Jones Industrial 3-month new high low at extreme overbought level. Russell 2000 extreme overbought 3-month new high low. Nasdaq 100 same. S&P 1500 same. S&P 500 same. All the major indexes, both the composites, are telling us that it is too overbought. And what about total view? Let me try to open it again. Very funny, for some reason it is not opening the total view. That's fine. Okay. I can see what I can do. It is not opening the candle chart, but we can see the 3-month new high low here already. That is already hitting the extreme overbought level. So anyway, we look at it, whether total view or composites or major indexes, it is flashing the signal that, like a clockwork in the past, has resulted in a pullback. That is a reason to be cautious. Overbought signs are not only in technicals. If we look at the sector, industry, stock advanced decline breadth from 1 month to 1 day, it is too green. So green that it is looking overbought. Earlier it was much less green, much. Suddenly it rallied, especially the small caps in last 2 days, and this became fully overbought, fully green in last 2 days primarily because of the huge gap ups and then further rallies in IWM on Thursday and Friday. Whether it is truly overbought or not, that warrants caution, that we know also from bucket analysis. In real time, it hit, I think, almost 50% on Friday. After market close, when the Bollinger Bands are recalculated, it is still at 36%, meaning 36% of S&P 1500 stocks are above their upper Bollinger Band. Whenever it hits 30 to 40%, a pullback almost always comes. Whenever the percentage of stocks above mid Bollinger Band goes up to 80% or more, a pullback almost always comes. Does it mean the market will enter bearish category? No. It will not need to be in downtrend for a pullback from the high, and we have very effective reversal trade setups. We could take them just like I took in Netflix. So all these are flashing warning signs. Not only that, it is telling that it is okay to look for shorts. What kind of shorts? Reversal shorts, maybe at price extreme high. Market analysis is not over yet. Very important part of trading profitably is to look at technicals, because we make profit buying a stock only if it goes up. We make profit shorting a stock only if it goes down. So let's look at technical breadth. Weekly first using Q Finder. Weekly is bullish, but so bullish that it is looking overbought. Across all the categories, it is more than 91%, more than 90%, more than 91. That is too overbought. Looking at that, I am thinking that it is time to start to short, look for shorts, but I am also noticing the large percentage of bullish headwinds in the weekly interval. Usually that leads to a further up move. What it is telling me that the stocks that were at a very low price level. Remember, weekly bearish, sorry, not bearish, weekly bullish headwind will come in a stock that is at a very low price in the weekly interval. Weekly bullish headwind comes in stocks that are at a very low in the weekly interval. In the daily, they are even at a more lower price. So those stocks are at a very low price, most likely value stocks. I think some of them I may look to buy. Value stocks at a very low price level starting to go up with bullish headwind in weekly, or maybe in general at price extreme low starting to go up, undervalued stocks. I may still look to buy them while I am thinking otherwise the market is overbought and I may look for shorts. Short what kind of stocks? The stocks that were at very high price level. That is what is shown by the internal breadth check and the external ETF technical analysis. This is weekly. In the daily chart, it is still bullish. That is expected. Thursday and Friday market was very bullish. But remember the long upper tail in IWM. IWM, the small caps were instrumental in making this green on Friday. Largely green. But the warning comes from reversals being primarily bearish and even more so from red candle high flashing warning sign, a huge number, 16% of stocks, and these are all liquid stocks, 16% of them displayed red candle high, a very high price level, and they declined from a high price level. So far all these analyses are telling me that I may look to short stocks that are at a high price level. I may look to buy stocks that are at a very low price level. Two opposite scenarios, and I may look for such candidates, both such candidates. Let's come back to today's theme. I mentioned I closed several trades even with a small profit because I had too many long positions, more than 20. And I'm not going to share all of them, but I will focus on ones that I shared already earlier. That is my way of explaining. YOU. This is a trade idea, bullish idea I shared in the previous market recap. That is, I shared it on this day and I bought it using stocks on this day when it held trendline support. I put my stop just below that candle's low. It did not hit the stop, it went up. At Thursday's high, it already covered my risk distance. But I did not book profit because on Thursday market was very bullish. Friday also market was bullish, but I saw it is now starting to move sideways. The white direction line that is declining is holding so far. So in a way it is between the white direction line resistance, watermark resistance and trend line support. I had some profit, not a large profit. I booked this position fully to reduce exposure. Also, I noticed the bearish indecision coming in both weekly, daily. I could look at all that. I could look at the overall market. I could look at more than 20 long positions I had in a very overbought market. And YOU, if you remember, or you may rewatch the video earlier market recap when I shared it, it does not have high dividend yield. So that was not a reason to hold the stock. I closed it with a small profit. Today's theme, when have too many positions open and market is too overbought, close some positions, especially the ones that you are not ready to hold longer term if required. This was one such trade. Another stock I shared was APTV. This I shared using the bullish headwind in the market recap 2 weeks ago. I took a long position in the trade, and on Thursday, Friday, both days it acted well. Weekly is also looking good. It completed the false downside breakout in weekly, and the headwind signal was very effective in my decision to take the long position. It had a small profit, nice profit relative to the risk, small profit. It also does not have high dividend yield. I had too many long positions. This is another stock I closed full position simply to reduce exposure, though the stock charts are looking all right. But I wanted to reduce exposure looking at the overall overbought market. Remember, if the market comes down, even the strongest stocks may come down. Later on, it may go up again, but it is very difficult for a stock to go up if the overall market is coming down, and overall market to overbought, I closed these also. Another stock, again, all these stocks I shared earlier, MTN. This also I shared in the market recap, I think, again using the bullish headwind signal. This is again, if you look at the stock chart, now people are starting to be bullish probably because weekly is now bullish color, bullish shape. Daily has a breakout, but I identified and I shared the trade publicly again before knowing the results long ago. I had a small profit. I did not wait. Why? Because again I wanted to reduce exposure. I closed more than 10 positions on Friday. These three are some of them. On the other hand, I explained that if you or I, especially I can speak for myself, if I'm holding a naked short put in a stock that I'm willing to hold long term anyway if required, then I may not book profit in it. And that was true, is true in VLY. I tweeted about the stock earlier, but I took the trade even before that using the bullish headwind and very nice dividend yield. Let's check that out. While it is retrieving data from Refinitiv, let me explain my trade. Somewhere here, using the bullish headwind and the fundamentals of the stock, high dividend yield, I decided to use naked short put, and I used the short put of 7 strike further in the money. After that, stock acted very well, went in my favor. Thursday had a big move up 3 at price extreme low. I bought it at the right time, perfect timing you may say. I have a short put where the short strike is below current price. And remember, I shorted the put when the strike was above my price. So I got a very nice premium. Now the short strike is below my price. So I'm perfectly okay to get assigned at 7 if need be. And the fundamentals helped me in that. Undervalued stock, short squeeze potential, insiders are buying, profitable company, whichever way you look at it, about 6% dividend yield, earnings is nearby. but my expiry is before earnings. My expiry is in 1 week time. So I'm holding it. Remember, I mentioned if I already have a large sizable percentage profit in the trade. I mentioned if the large profit came well before expiry, I would close it. But now I am nearing expiry, just 1 week to go. I want to let it run, and most likely I'll get 100% profit in the trade. If not, if I get assigned, fine. But it is difficult to make a loss in such a trade in my experience. Nothing is guaranteed, but anyway, it has a high dividend yield. Only 1 week to expiry, I am targeting 100% profit in the trade. I did not book profit. This I am willing to do only in stocks that I am willing to hold in the worst case. I also mentioned about a stock that I am holding and I did not book any profit, and it is not a short put naked position. It was a stock BHC. And see how beautifully the bullish headwinds helped me in anticipating a reversal at the bottom. This was a stock I shared publicly, and I mentioned also I took a trade at jump thrust low, price extreme low, using the bullish headwinds. And I also mentioned exactly how I traded it. I took a covered call, that is, I bought the stock and sold 7 strike. I specifically mentioned 7 strike call. This is what I told when I took the trade, and later when the stock was going up, what I mentioned was what I planned, that once it hits my short strike, I would book partial profit. That is what I planned. But it went straight above my short strike. Looking at that, I did not book any profit. What I am now thinking is that I have a short strike of 7. It will be favorable for me, in fact, for the stock to go to strike 7, maybe even go down little bit and then start to go up. The calls will reduce value a lot, and that is the time I am going to close my short call legs, also book some profit on the stocks, and let profit run on remaining stock position. This is how I entered the trade. This is how I planned it, to book partial profit at 7 strike. But because it moved so well in my favor, now I am actually waiting to see if it pulls back. If it goes straight up, further up, it's no harm. I have a positive delta in the trade, still high delta, positive. So I am happy if it continues to go up. I am also happy if it comes down, in fact, below 7 strike, below my short strike, and then start to go up. That will be the perfect time for me to close the short call legs. And also, of course, I will close some of the stock position also. It is not fully balanced covered call. I should say that I did not mention that earlier. I have a large number of lots covered call. I have some uncovered stock position also, but most of them are in covered call. So that is one stock where I am holding full position, and this is also exactly how I am planning to manage the trade. Now let's look at some buying and shorting candidates. Why buying candidates? Because the weekly bullish headwinds in Q Finder, they are telling that it is okay to look for buying candidates at the very low price level. So I'm going to do this. For a long candidate, let me do a top-down analysis. That will be a good practical demonstration. For short candidate, let me do a bottom-up analysis. So let's start with top-down. I'm looking for a bullish trade. For finding trades, I don't look at sectors. I look at sectors, but I don't drill down from the strongest sectors, because then I may miss some of the stronger industries. So I look at the sectors, but my drill down for top down starts with industries. And because I am looking for stocks at a low price, I hope undervalued, hopefully with a dividend yield, low price level, those where earlier falling, so let me look for not industries that are strongest, but industries that are most accelerating, top 20% accelerating. So I'm not using the strength column. I could do that also, but I am looking for turnaround candidates. Okay, but I don't want to look into S&P 1500 stocks. I will generate a scorecard of liquid stocks. I have it in my stock trading universe, liquid stocks, but to save time, let me use a smaller list, mid-price stocks. They tend to move bigger percentage also. So let me create a scorecard of that first, and then I will drill down from the most accelerating industries into these liquid mid-price stocks to find fundamentally strong stocks, hopefully with a dividend yield, and then further look for trade setup. Let it generate the scorecard, retrieving data from Refinitiv. Give it a few seconds, please. The more you use these systems, the more you see how powerful they are in carrying out the exact workflow that you want, and how perfectly you or I can time trades like BHC, like APTV, like YOU, like MTN, perfectly timed for short Netflix. And here I have generated the scorecard. Let's see if we can perfectly time a buy candidate even in this overbought market. So these are the most accelerating industries. I am now drilling down into the mid-price liquid stocks. I want to find stocks that are up on Friday. Okay, I clicked one button. I want to find stocks that have dividend yield, let's say at least 5%. So only these few. Let me find out if they have any trade setup from QFinder. Single click. This is perfect top down, and instantly I see there is only one breakout at price extreme low. That's good for this demonstration. There are other setup, no other setup in fact. Interesting. Only one high dividend yield stock in an accelerating industry at a low price level giving a bullish breakout, APLE. And this is the time I would like to generate a single page scorecard. Remember, I started with all accelerating industries. I did not look at industries one by one. I started with all liquid mid-price stocks and then dividend yield stocks. I didn't look at them one by one. Now, before deciding on a trade, I am looking at that specific stock, not in a tabular form, but in a scorecard. And now you see it is undervalued, great earnings quality. Next earnings date is some distance away. It's a profitable stock in whichever way you look at it. Has steady revenue growth across 3 quarters and 3 years. And I looked for high dividend yield, 6.6% dividend yield. Hotel and resort rates. That's interesting. If the market becomes under pressure, the defensive stocks like rates with high dividend yield are expected to do better. Steadily going up, I can know that before opening the chart. 76% of peer stocks went up. Insiders are buying, and I like this earnings growth tilted down went up, revenue growth tilted down went up. It's a turnaround candidate. And remember, industry wise, okay, refresh the data. Let me generate the scorecard again if it allows me. Yes, industry wise also I looked for most accelerating industries. So if I look at only this industry, it is also a turnaround candidate. It is not strong industry by any means, the color coding says that, but it is one of the most accelerating industries It's a turnaround candidate in terms of fundamentals, and I already know that it is at price extreme low with a breakout setup. And see, now I am going to look at its technicals. This is proper top-down analysis. You could do that in real time. And now we see weekly is bullish in color, in shape, created a false downside breakout with bull release signal. In daily, multiple false downside breakouts, and now it broke out of the last trend line resistance. There is another one, but that's far away. This is giving a breakout setup and at price extreme low and reversing. This is exactly what I looked for from Finder. So this is my buying candidate for this week, and it has a high dividend yield. I did not check its options. If options are liquid, I'll be happy to use naked short put in this stock. If dividend yield was not high, I would use naked short, not naked, I would use short put vertical, but dividend yield is high for me, enough high. I am happy to do naked short put if liquid options are there. Otherwise, I could buy the stock. I did not locate it on Friday. I did not take a long position in it. I'll keep an eye on it, and I'll try to take a long position using real-time chart, because on daily chart it has already gone up for few days. So let me save the stock. And now for a shorting candidate, let me do a bottom-up analysis. So I am showing both today. For short candidates, I look to short at high price level. So I came to all the short candidates, click this paint bar, sorry, not red color, the green color. So stocks at extreme price high, and I'm going to look for stocks with a breakdown. So I have only 4 stocks. These are all breakdowns at price extreme high. Now is the time to generate their fundamental scorecard. Perfect bottom up analysis using visual signals. 4 stocks, created the scorecard. Let's go to the scorecard, look for 1 star red candidate. So either overvalued or negative earnings growth. Okay, by the way, I see there is none actually. So if I click 1 red star, none of them are going to come up. That's fine. Let me get back to those stocks, and let's say now, see, there are other smart filters. As I explained many times earlier, a stock starts to go down not only when earnings growth become negative, but when earnings growth starts to reduce. And this smart filter allows me to find them. Let me see how many of them. 2. 2 of them have decreasing earnings growth, but one of them is undervalued, not this one. So between them, without looking at their technicals, both of them are breaking down, but based on fundamentals, I prefer to short HWM. But before that, let me generate the 1-page scorecard now, step by step. That's good. See, almost opposite kind of stock. The bullish candidate I found had a high dividend yield. The bearish candidate I'm looking for has very low dividend yield. The bullish candidate APLE I found insiders were buying. Here insiders are selling. In the bullish candidate APLE, earnings growth was going up. I showed a tick mark here, but here it is reverse tick mark. Earnings growth is coming down, revenue growth coming down. In the bullish candidate, both were going up. Almost opposite. Aerospace and defense industry. Let's look at the industry strength or weakness. Great. Almost opposite. The other one was accelerating rates industry, and this is decelerating, one of the most decelerating over 2 days, and you can see the strength weakened very fast. So now is the time to look at its stock charts. HWM, great, great. Came to jump thrust high, price extreme high, gave the big move down 3. Almost always, I hesitate to say always, almost always, if the fundamentals are weak, this pattern comprising of these 3 signals lead to a down move, and on Friday, though the market went up across the board, the stock broke down below trendline support. Not only that, it displayed a bearish flow, and therefore it also gave a bearish flow trend following short setup. Weekly allows us to take that flow short setup. So in fact, if we look at Finder, I think it will have 2 short setups, not only one. The bearish flow short setup, breakdown short setup with a bearish fan out pattern at price extreme high pattern. The stock is still uptrending, but it is giving us a short setup. Again, I think a perfectly timed short setup for HWM, and APLE I will not say perfectly timed, because breakouts sometimes mean that the stock has to move up, like in this case. So my stop would be little bit far away. I am still probably okay to buy APLE because of high dividend yield, but I will not use the daily chart. I will try to enter APLE using real-time fine-tune chart, whereas for HWM it was perfectly okay to short it on Friday itself using daily chart, and it will be perfectly okay in my view to try to short it on Monday also if it continues to go down, or even better, tries to go up and in fine-tune starts to go down after that. If you carry out the 360 degrees analysis using top down, bottom up, or fundamental first, or even seasonality first using Q, like I demonstrated in 2 workflows, you will most likely find other buying, and in the current market situation, other shorting candidates that are high probability trades. Just as you could find them today, you could find them in almost every other day. I'll not spend time on that. I'll leave that to you. Let me end today's session here. Thanks a lot for joining. I look forward to seeing you in my next session. Have a great weekend. And as this live example show, as I always say, there is no reason not to do that. Trade profitably. Thank you.